But I want to thank you all for coming. This is our inaugural conference. We sold it out 3 weeks ago. What I like best about this conference is that I will be able to make some very large contributions to charities that benefit children, and I wouldn't be able to do it without all of you. Earlier this year, I was invited to go to Charlottesville, Virginia, to the CFA headquarters to do an educational video on the hedge fund industry. And during the hour video, we touched on a number of different subjects. One was how to analyze hedge fund performance, risk, correlation, portfolio optimization for a diversified hedge fund portfolio. A lot of those sound really simple, but they're actually complex. We can go pretty deep into each of those. We also discussed trends in hedge fund fees, institutional use of hedge funds, and what strategies are seeing an increase in demand and why. However, given the limited time today, I want to talk to you about upcoming performance standards for the hedge fund industry that the CFA is planning to come out with later this year. And I think it should have come out with that, 10 years ago. So I applaud their efforts. I just hope it is done well, so it is implemented broadly across the hedge fund industry, and I hope it is done in such a way that everybody benefits. The reason I'm talking about it today is I think now is the time to talk about it. Right now, we're talking to a bunch of different people, and they're trying to figure out what these performance standards are going to include, which is why I'm giving a speech today to communicate things that Agecroft is seeing, and in addition to that, we're going to write a white paper on the industry. Now, currently people have a lot of discretion on how to report their performance, as long as they put in their disclosure statements that are written by their law firm, which are biased towards the actual hedge fund. Some of the obvious issues are simulated performance from a previous firm, and managed accounts. And again, I think it's fine that people do that as long as it is highlighted on the performance page, and as long as there's some type of industry standard to describe what they're showing. For example, managed accounts. Is it a composite? Are they cherry picking a managed account? How do they determine what the performance of this is? The less obvious is performance minus expenses and fees. And this sounds really simple. I mean, how could you have any difference in how you report net performance for a hedge fund manager? Well, it's not as simple as you think. And I'm going to give you 4 examples. And the way people calculate it can generate significantly different performance. So the first is a hedge fund that is started out and is seeded by the founders of the hedge fund, and they don't charge themselves fees, okay? And they're trying to sell their fund, and they don't get any new accounts, and 2 years later, they start bringing in new accounts, and they grow the fund over time. So the question is, how do you show your performance? So some hedge fund managers will show their performance based on the net performance of the fund. But that overestimates the skill of the manager, since there were no fees charged the first 2 years. There's others that show hypothetical performance. And they show performance assuming full fees are charged from day one on all the assets in the fund. Now, the way to think about this, let's assume the fund generated 10% return. And let's assume that the fees are 1.5 and 20. The difference between those two managers is around 3%. That is a massive difference for the exact same skill set. It's just a difference in how they show their performance. Let me go to another example. A hedge fund starts off with founder share. They're charging 1 in 10. And when they reach $150 million, they're going to raise their fees to 1.5 and 20. So how do you show your performance in this situation? Some people show the net performance of the fund. So it's going to incorporate the founder share first, and then it's going to kind of bolt on the higher performance after that. There are other people that show hypothetical performance, assuming the higher fee since day one of the hedge fund. And they're doing a disservice to themselves, outselling founder share, but showing performance minus a 1.5 and 20 fee, which is unfair to them, and I don't really think reflects what the people in the founder share will get. Another way of doing it is to show the net performance of the founder share, and then once you fill that up, restate your performance in everybody's database, assuming a 1.5 and 20 fee, which is what I think people should do. I think if you're invested in the founder share, you should see what the performance would be for that founder share. And once the founder share is closed, I think you should see hypothetical performance that shows what the net returns would be minus whatever the new fee structure is. Another example, and this is becoming more common in the hedge fund industry, is a graded fee schedule. And if any of you have been on the long-only side, most long-only managers have graded fees, meaning the more money you invest, the lower your average fee is. And the managers that have graded fees, they don't want to negotiate. They want to say, if you invest below 25 million, here's your fee. Between 25 and 50, it's going to go down a little bit. 50 to 100, it's going to go down some more. Again, there's multiple ways to calculate this performance. You can calculate it based on the net performance of the fund, or you can calculate hypothetical performance, assuming everybody in the fund pays the highest fee structure. The last example is a manager charging 2 and 20. And we've worked with a manager that did this and decided their fees were too high in the marketplace and decided to lower them. And this is actually a really good manager. This is not a manager who was in a distressed situation. And they lowered it to 1.5 and 20. And the question is, how do you show this performance? And I think the way you show it is, as soon as you lower your fees, you should show hypothetical performance, assuming that's the fee schedule people pay from day one. I mean, the key is investors need to be able to evaluate a hedge fund, and you've got to have apples to apples. And if you assume all assets in the fund are charging whatever the highest fee structure is, then that way you can compare one manager to another, and you don't have these massive differences in performance across funds whose skill set is identical. Another thing that I think needs to be addressed by these new performance standards is expenses charged to the hedge fund. Some people are very aggressive, some people are very conservative, and I think investors need to know. I think there needs to be clarity, and a lot of clarity in what expenses are allocated to the hedge funds. They also need to know what the expense ratio of hedge funds are. And I think if you have, where this is most important is for people invested in the long short. They can't deduct the fees like they used to. But I think with greater clarity, there'll be less expenses allocated to the investor, and I think the whole industry will be better off relative to that. Another issue I want to address relative to performance is how to handle separate accounts. Back at the turn of the century, there were very few separate accounts outside of the commodity trading advisor or CTA industry. And today they're becoming a lot more common. And I guess the question is, if you're a big public pension fund, someone has a hedge fund, someone has a separate account, how do you know, if you're going to get the same performance in a separate account? So I am not advocating GIPS, Global Investment Performance Standards, that create some type of composite that combines the hedge fund with separate accounts. But I do think investors should be able to see the difference in performance for a separate account versus a fund. And sometimes, you're just not going to be one pair of a suit. If you're doing a managed account for HFR or Elixir and providing daily liquidity, they might not be able to own some of the less liquid securities. And speaking of less liquid securities, people need to understand what the valuation guidelines are in the fund. What's the issue with illiquid securities? The issue with illiquid securities is they're not valued very often. So what impact does that have to the portfolio? Well, it reduces volatility. It increases it increases Sharpe ratio. It distorts correlations, and it also distorts what the tail risk is in the portfolio. I mean, a good example is a direct lending fund. You know, in direct lending funds, some of those old securities are books, they may mark to market, they don't do it all very often. It's going to smooth out, have a very low standard deviation, a very high short ratio. Correlation is not going to look like it's that correlated to other asset classes. But during a market sell-off, if the fund terms and the liquidity provisions don't match up with underlying securities, they may have a lot of issues, or you can see deterioration in credit quality of those loans. I think there are huge benefits to investing in illiquid securities. And I'm not saying people shouldn't, but I think people need to understand how illiquid the portfolio is and how that impacts all of these investment statistics that people use to build portfolios. So just to summarize, the CFA is coming out with performance standards later this year, and now's the time for the hedge fund industry to speak up and try to mold those for the best interests of the hedge fund industry and investors. I mean, hedge funds want to compete on a level playing field, and investors need appropriate information to make the best decisions for their portfolio. We're going to be writing a white paper on the subject. I would be interested in any of your views. If you have any views, don't tell me verbally at this conference, because I am never going to remember. Just send me a very brief email, and I'm happy to look at whatever you send me. With that, I want to thank you once again for your time. We're going to open up lunch for everybody, and I look forward to mingling with you the rest of the conference. Thanks a lot.